importance of, if you don't get nothing else out of this, you need to understand the importance of paper trading and how important that is. Most important thing you want to know is that, that's where all your learning, that's where all your, you know, fine tuning of your skill set, everything comes and works when you're doing the paper trade. We learn and go through the lesson, go through all this information and stuff, but we got to put it into action. And when it really starts to come together for you is when you start paper trading. And you learn so much and stuff start clicking and making sense once you actually get in that market and start paper trading. But we miss it sometimes because we can see paper trading in the wrong way. I had so many times where I had to try to explain the importance of paper trading, and somebody says to me, "Well, yeah, but it ain't real money," and we can sometimes miss the whole importance and the reason behind paper trading. If we take paper trading serious and understand how important it is, we'll realize that our paper trading is what allows us to get in the market and make money in our actually live real account. It's from the paper trading. We don't want to get into the market and just learn and make all these costly mistakes where we can learn and kind of fine tune a lot of that during our paper trading stage. So it's so important. I can't stress it enough. That's how important it is. But I want to get into the lesson what we got, and I want to see if we can get into our disclaimer. Barbara, are you able to go through our disclaimer before we can get going?
Yes, I am.
Okay.
There we go. All right, here's our disclaimer for Futures and Commodities Trading Group. Trading and investing carries a high level of risk You could lose some or all of your investment. Trading commodities or any other financial instrument may not be suitable for all investors. Before deciding to trade, you should carefully consider your investment objectives, level of experience, and risk appetite. We accept no liability for any losses or damages you may incur. This means that you alone are responsible for your actions in any trading or investing activities.
Awesome. Thank you. Thank you. Is Dr. Melville with us?
No.
No, she's not.
Okay. So, and then the way I can get either your authority to go into the quiz as far as
Miss Thorpe usually does them for her. Miss
or
Thorpe,
are you able to? I know we had like 2 weeks worth.
if she can't do it, then I'll get it if she is not able to get it.
Yeah, I don't know.
Yeah.
Yeah, I have it.
You have it? Okay, great.
28th of April, yeah. Mhm. Okay, the first one. It doesn't matter what market you look at. The formations that we watch for appears on the chart. Forex, crypto, stocks, and futures. Doesn't matter. Again, it doesn't matter what market you look at. The formations that we look at or that we look for appears on the chart. It appears on Forex, crypto, stocks, and futures. Doesn't matter. Is it A, false? Is it B, true? Or is it C, not show? Okay. Ezra says B, and TKFDP says B. From the chart. Okay.
Yeah, I ain't heard nobody. That must be in chat because I ain't hear nobody. So
B.
Yes, in the chat, yes.
Okay.
That's true. I think.
What was that? I heard Paula. Did somebody, was that Paula say something? Are we saying that it's true?
Yes, I did.
Okay, what you say, Paula?
Well,
True?
I said it was true. Sorry.
Okay. Anybody disagree?
Lulu is also saying B. True.
And B too. So everybody's saying true.
Yeah.
All the charts, the formations appear on all the charts, no matter which market it is, right? All right. Great job. What else we had, though? I think we had like 2 weeks.
Yes, the second one. If you want to trade the market down, you have to place your order to buy a futures contract first. When you are filled, you will be short the market. I'll say it again. If you want to trade the market down, you have to place your order to buy a futures contract first. When you are filled, you will be short the market. Now, is it false? Is it true? Not sure, C, or none of the above? Again, is it A, false, B, true, C, not sure, or D, none of the above? Okay.
All right. Let's go, y'all.
One person. Was it TK?
Somebody come on.
F. J. King says A. Oh, I have somebody else, but I didn't get it. Okay. Lucky
So,
reads is B. From the chat. Okay. Franklin Smith says false.
it's kind of different this go around. Everybody in the chat, we normally have people unmuting and answering the quiz. It's kind of different this time go around.
Yeah. Yeah.
Yeah, I be waiting on
Right.
everybody.
You think I would have got this one right since I put A in the telegram and got it wrong. I put it in his. Used it. I still got it wrong. Okay.
That's how we learn.
You feel like you got it wrong tomorrow?
Yeah, because everybody was telling me that I got it wrong on the first time in the telegram group. And then I chose the same letter right here. It's crazy. I should have known that it was false because if I didn't get the first one right, it had to be false. But it's all right. I'll get it.
Well, let's look at it. Let's see how we know. We don't know who was right or wrong yet, do we? Um, one more time. What was the quiz question again?
Okay.
Mm-hmm.
And I
If you
think Dr. Miller just came on
Yes.
too.
Yes, it does to her. Okay. If you want to trade the market down, you have to place your order to buy a futures contract first. When you are filled, you will be short the market. Is it A, false, B, true, C, not sure, or D, none of the above?
You know what, though? Let's see something.
If you're
Can someone who's saying that it's
um,
false, can somebody who's saying that it's false, can you unmute and tell us why it's false? Who can tell us why it's false?
Let Lucky come on.
I thought it was true. If you're shorting the market, you're trading down.
That's right. If you're trading the market, if you're shorting the market, you're trading it in the down direction.
Okay.
So in this particular quiz question, we asked about whether or not what when we place our order, will we buy a contract first or sell a contract first? I think it basically said that we will buy one first if we wanted to short the market down. And most of the people said that that was false. And I wanted to know who can tell us why it's false.
Because the question says to buy or to purchase, and in order to short, you have to sell first and then buy after.
Awesome. Awesome, Paula. That is absolutely correct. In order to short the market, when you place your order, you have to sell a contract. Remember, we talked about when we trade the market to the upside, we buy first and then we sell second to get out. And it's the complete opposite when we going short. We sell a contract and then we buy second to get out of it. Very, very good, Paula. Man, man. So are you continuing, or you want to check with Dr. Melvin see if she want to take over?
Yeah, check with her. She's
Oh,
here.
Miss Dora, continue. You guys doing a good job.
Okay.
I don't think we have another one though. That's it for the questions.
That's all of them?
Yeah, it's just two.
Okay. I don't know why I thought we had like 2 weeks worth of quizzes. Okay. All right. Well, good deal. Good deal. Thank you so much. So, Papa, what we have for tonight? Let's jump right on in.
Yes, sir. So we
Oh,
have an awesome video on paper trading. So that's what we're going to learn about tonight, which is very, very important. And we want everybody to know that even after your 30 years of trading, you yourself still paper trade. So that's something you
Yeah.
can always do.
And before we play the video, I just want to, because I think it's so important, like I was just saying earlier, that people understand how important this is. I just want to, if it's all right, mention, the if y'all not aware that when Barbara and Dr. Melba first started, they took their time and paper traded till they got comfortable and was ready to get in the market. And that's what's so powerful about what we do. You can do this at your pace or on the level that makes you comfortable. So just because it may be recommended to paper trade for a certain period of time, if you're not ready to get in the market or you not feel like it's not time for you yet, you can paper trade until you're ready. And just because we start trading with real money don't mean we have to stop paper trading. So even after all this time, I still will paper trade. Eric still
Wow.
paper. Eric just shared a paper trade with me that he just did. People get into the market and think that once I start trading with real money, I don't have to paper trade anymore. You're still learning, and you're gonna still want to keep working on your skill set. So paper trading is that important. That's why I keep stressing it, because it's that important. All right. I just wanted to
And
add that in before we get started with the video. Did somebody say something?
yeah, I was going to say something. And the disclaimer speaks to the urgency of how you should be putting paper trading at the forefront. You want to be coming back and talking about I lost this and I lost that, and you have to keep telling people the same thing about paper trading. And then if you've been doing this for 30 years and you paper trading, that should be a clue. That should be a clue.
And you're gonna always need to keep paper trading, man. That stuff that's gonna keep coming about. You're gonna still get in situations you never been in before. You're gonna keep seeing stuff you never seen before. Imagine trading a market that's trading at a price that it's never traded before. It's at an all-time high or all-time low. So you really don't have anything on the chart to kind of guide and help you because it's never traded at this price before. So you can't go and try to see, okay, well, last time it was trading at this price. There is no last time. So there are situations you're going to get in where you still need to learn yourself. You'll never get to a point where you start learning when it comes to trading. Just remember that. But thank you, man. Good input. Robert, let's jump on in with the video that you have for us. Uh-oh, did we lose Barbara?
I just let her back in.
Okay. Dr. Mel, why she doing that? Can I ask you a question? When it comes to paper trading, how important do you feel like that was to you when you got started?
Oh, it's not a was. I paper trade all my live trades. I still paper trade them because I am very quick to secure my profits in my live account. And so I continue to paper trade the same live trade in my demo account to see like if I made the right decision when I got out. Because you never know when the market's going to turn, because you get what the market gives you. And so I paper trade to see if, I made a good decision or my stop loss was in the right position. Like you learn, like we teach you to learn the personality of each commodity that you're trading. And each commodity does have its own personality. And when we say personality, certain commodities will close gaps quickly. Certain commodities, they'll wait 10 years to close a gap. Another commodity, it follows the cash price. And so therefore, it may have made a 1, 2, 3 top, a 1, 2, 3 bottom of the cash prices is an opposite direction. It'll just negate the 1, 2, 3 top, 1, 2, 3 bottom, and just head for the cash price. And so you have to learn that about the commodities that you're trading. And to do that, a demo account or paper trading is really important because it helps you learn the personality. And so once you get, you learn the personality of certain commodities, then you get to a place where you learn how to put certain strategies in place for certain commodities because it's more fun to trade that commodity with a certain strategy versus another strategy that you know that your risk is going to be too high, or the chances of that commodity of doing something that you're not comfortable with can happen in the middle of the trade, and then you have to, mitigate your risk. So at the end of the day, paper trading is something that I do with every live trade. And so it's probably, I would recommend that each person starts doing the same thing once you even go live trading, that you continue to paper trade because you can only continue to learn more, about each commodity that you trade by paper trading it alongside your live trading.
Wow. I want to make sure everybody hear what Dr. Melvin just said. I shared this. I'm so glad you brought that. I shared this with Eric at our retreat, and he was like, man, he was blown away. Did everybody hear that? What she said? No matter, whenever she puts a live trade in, she also trade that same market with a paper trade as well. Did everybody hear that? If she gets into a trade with
Yes.
sugar, she has a live trade going on with sugar, but she also paper trading it simultaneously at the same time.
Hmm.
Yes.
That
Yep.
This is a nugget. Yes.
is a huge nugget. A huge nugget. Did everybody hear that? If you really want to learn, that's how you learn. Wow. Thank you, Dr. Mel. Are you ready for us, Barbara?
Yes,
Okay.
I just need to be able to share the video. I can't share the video.
Go on, that's you.
You gotta do me. Can you do co-host so I can share video?
Got you. That's you. my fault.
Well, which do you buy? Well, which do you buy? Do you have unlimited funds? No, none of us do. So, which of those 10 or 15 are you going to buy? You get anxious, you get fearful. Then the next issue arrives, and maybe you haven't even read this issue. So now you're behind already. And the next issue comes and there's 10 or 15 more to buy. So now what stock should you buy, or what commodity should you get into? Well, you can't trade that way. You cannot make money like that.
The New York Stock Exchange is in a panic. Frantic investors have scrambled to unload their stocks at any price. Everyone wants to sell. No one wants to buy. Suddenly, even the most gilt-edged securities are practically valueless.
That's the way to lose money. You have to be your own advisor, and you are the best one for it, and you can know all the answers.
Well, it's just like Kenny said, no one knows what you think they do.
Now, it is true that I do have some more knowledge about the market than you do, but it's not that I know any secret. It's just that I've sat down with my charts and I've done the work. That's what you're going to do, and that's what this video is designed for, to help you get going. Now, let's take a look at some financial terms you've seen in magazine articles. You're reading the books out there on commodities trading, and I'm telling you, don't waste your money on the seminars and the books out there. Don't waste your money on the newsletters. Don't buy those things.
Now remember, nothing is what it seems.
Read the books such as the ones I offer through 4-Star Books. Now, why? Those are where you should be looking, because those books are gems that will truly help you. They'll help you because they point you in the right direction. They show you where success really begins. Now, when it comes to trading, don't stray off and look at fundamental analysis. What you've got in my course works. I proved it. I'm showing you my own accounts in the monthly issues of the newsletter. You're hearing my real money trading on each edition of the alert lines. And you can hear how other course members are doing by calling the Conversations with Course Members line every week. It's all there. It works. It's even award-winning. So let's take a look at fear. We do this at my seminars by making a list of the terms and techniques that you see referred to so much. You see it in the charting services, you see it in the magazine articles, you see it in newspaper stories, and you see it in commodity and investment textbooks. So let's make a list of these terms and take a close look at them. First, you'll need a pencil. So get your pencils out. Get the point? Now, here's the one big term that everyone at the seminars knows. RSI, Relative Strength Index. Another one is stochastics. That's a good one, stochastics. Another one is point and figure charts. You'll see those in some of the charting services. Another one is Gann lines. Gann lines. Entire books have been written about Gann lines. And then there's Elliott wave theory. This isn't a surfing book.
I can't believe it. That mean old Elliott and his waves had me so confused.
There are actually Elliott wave theorists. There are newsletters, articles, and entire textbooks on Elliott waves. Then, in some of the charting services you get, commitment of traders is listed. This tells you how many industrials are in a market, how many novices are in a market, and some give you overbought, oversold indicators. Oh, and how about Fibonacci? That's a great one. Who was he? An Italian explorer or what? I don't even know how to spell it. Another one that's out there is ADX. ADX has to do with moving averages. RSI, stochastics, point and figure charts, Gann lines, Elliott wave, commitment of traders, overbought, oversold, Fibonacci, ADX. Now, let me tell you something about all of these, and you may have even more to add to that list. Even we learned more at the seminars as we traveled around the country. Every one of these is a term invented by men to impress women. That's it. That's the secret behind all of these terms. Oh, Fibonacci, I love you, Fibonacci. Talk commodities to me, Fibonacci. I love you. What happens is a man is talking to a woman at a cocktail party and he says, yes, I'm in commodities. And she says, oh, you're a commodity trader? Already she kind of thinks he's a nut, but she's a little bit intrigued, right? You've told your friends about commodity trading, haven't you? So he says, yes, I'm in commodities. I'm in the pork belly market right now, and I was looking at the stochastics in the pork belly market just the other day. And she says, really? You were looking at the stochastics? Yes, and the ADX indicators. I always keep a sharp eye on indicators. So, fellas, these terms are great for impressing women, but as far as trading goes, forget it. Learn what I'm showing you on this video.
As Ken says, people should be seekers. There's no experts. No one knows what you think they know. So if you want to get rich, go to someone who's done it.
I want to tell you something. It's so much easier to paper trade than it is to make one of these videos. We've been here about 4 hours today to do 30 seconds worth of tape for you. But this morning, in about 15 minutes, I did all my trading. I took $27,000 in profits, I updated my charts, and that was it. Now, what do you do the rest of the day? That's why you get different mailers and letters from me, so you'll have some ideas on what to do. Right now I'm going to bring on Matt because I want to go finish this cigar. Matt was a stockbroker when he became a course member, and I want you to know that he is an active, real money trader, and Matt is in charge of our course counseling department. It's because of his efforts and insights that the course counselors are able to help you as much as they do. I also want you to know that Matt actually trades the S&P market, which I don't even trade. Matt will show you how to paper trade using our brand new U.S. chart commodity charts. These are the charts that you've read about in the newsletter and heard about on the alert line. They have everything I want as a commodity trader, but not all of the useless stuff you don't need. And they're very competitively priced. It's the best product out there. And because we're ecologically correct here at the Ken Roberts Company, here's a little tidbit. These charts are printed with soy ink on recyclable paper. Now, what that means is don't throw the charts away when your new charts arrive. Save them up until you have a big bundle. Then throw that bundle into a big pot and boil them. And you and your family can actually eat these charts. We think of everything here.
Ladies and gentlemen, the Ken Roberts Company does not recommend the consumption of U.S. charts as an edible product. Please do not eat these charts. They're much better read than eaten. Now, let's get back to the video.
Hi, I'm Matt, and I'm going to teach you how to paper trade. But before we get started, there's something I want you to think about. I want you to think about the fact that you apply commodity trading principles every time you go to the grocery store. You're walking through the grocery store and you see coffee is cheaper than it's been in several months. What are you going to do? You're going to buy extra because it's so low. On the other hand, if you walk into an aisle and you see that the price of something is unusually high, you're going to wait because you figure the price is going to come down. That's exactly what we do when we trade commodities. Remember, we're talking about real prices for real goods based on the law of supply and demand. Prices that are high will probably come down. Prices that are low will probably go up, and prices that haven't changed for a while probably will. Commodity prices will go up or down, but they will never go away. Let me give you an example of the difference between stocks and commodities. Boise Cascade is a company that deals in lumber. The company could go bankrupt and the stock go to zero, but lumber will never go to zero. Lumber will always have a value. Now I'll help you put aside all your concerns about not being able to learn the world's one perfect business. There are just a few things you're going to need to get started. You're going to need a source for getting your price updates, but you only need to update the market you're watching. We recommend finding a broker who has an 800 number for quotes. Any broker who wants your business will help you through this crucial learning period before you open an account. You'll need some form of record keeping. Ken and I prefer to do our record keeping right on the charts. Many course members have designed their own forms. You can make up a form that works for you. This is your record keeping, and the record keeping part of it is what's important. The only thing that matters is that it's clear to you. You're going to need a set of charts. You were given a sample set of U.S. charts in your course materials, and this sample is all you need. The beauty of U.S. charts is that we've taken the effort to include some blank chart pages in the back of the book for you. It's okay if the chart is a few days or even weeks old. We're interested in what's happening from this moment on in the market. We can't trade a move that's already happened. At this stage, the important part of the chart is the legend and price scale of each commodity. Of course, you'll need a pen and a ruler and your alert line message. If you're listening to the alert line, this is what you'll hear. March corn's #1 bottom point is 220 1/4, the low on November 23rd. The #2 point is 232, the high on December 10th. Keep watching for a bottom formation. 1 cent in corn equals $50. By the way, this is what the alert line message would look like if you had the fax or internet service and received it in printed form. This is the easiest and most convenient way to receive the alert line message. If you have access to a fax machine or the internet, you may want to look into this option. The commodity is March corn, and the alert line message at the point I picked up this particular trade identified the 1 and 2 points. I'm watching for a 3 point to complete this bottom formation. Don't worry about what happened the days between the #1 point and the #2 point. That's in the past. We'll just proceed from here. This is how it looks on the chart. You can see that I have made my notations right on the chart. I want to remind you again that when we're talking about commodities, we're simply talking about products we use every day and their prices. The high of the day is the highest price paid for corn that day. The low of the day is the lowest price paid for corn that day, and the close is the last price paid for corn that day. When we say March corn, we're simply talking about corn that will be delivered in the month of March. That's what futures are. We are agreeing to buy or sell at today's prices a product that's going to be delivered in the future. I want to remind you that a #1 point is the highest or lowest price paid for a commodity in the last 12 months. Corn is quoted in cents per bushel, so the #1 bottom of 220 1/4 means that the lowest price paid for corn in the last 12 months was 220 1/4 cents per bushel. If we were looking at a #1 top, we would be talking about the highest price paid for corn in the last 12 months. Now, to follow this trade, you have to update your charts every day. Since a #1, 2, or 3 point can be a high or low of the day and not necessarily the close, you'll need the high or low to update your chart. In a bottom formation, the #1 point is a low, the #2 point is a high, and the #3 point will be the low. I update my chart by putting dots at the high and low of the day, and then I connect them with a vertical line. The #3 point is confirmed when prices fall from the #2 point, but do not exceed the #1 point and begin to move up. Don't let charting throw you. Don't be concerned about the dates at the bottom of the chart. This isn't rocket science. You don't have to have every tick and dot in exactly the right spot. It's the formation we're interested in. For accuracy, you can write the price of your 1, 2, or 3 points right on the charts. That will eliminate any confusion about the actual price when you get ready to place your order. You want to have everything very specific at that time. Once the #3 point is confirmed, we're ready to place our order. This is when things start to get exciting. You can see the #3 point of 226 confirmed as prices went up on December 21st. Now, if you have a weekly chart subscription, you may not want to update your charts at all, since your new chart will arrive at the beginning of the week and be updated through the previous Friday. The chart showing the #3 point confirmed would have arrived on Monday or Tuesday. The #3 point happened on the previous Thursday. When plotting a formation, it's unusual that something critical will happen in a week's time. Here, take a look at the updated March corn chart when the #3 point is confirmed. We place our order. We place a good till cancel order, which simply means that our order will be good until it's filled or we cancel it. We have a bottom formation, which means we have low prices, so we're anticipating prices will go up. That means we're going to buy, which is the same thing as going long. We will place an order to enter the market when and if the price breaks above the number 2 point. If filled, we will have an order to exit the market if the price breaks below the number 1 point. The reason we use the number 1 point and the number 2 point to place our orders to enter and exit trades is that technical trading in commodities deals with certain principles and probabilities. There are certain price movements that have a tendency to occur over and over again. But there are no hard and fast rules in commodities trading. That's why we can't tell you how many days there are between your 1, 2, and 3 points, how many days it will take to get your order filled, or how long the trade will last. These principles are not scientific formulas that predict what's going to happen. They only give clues to what may happen. The more you paper trade, the more you go through this process over and over, the more it will make sense to you, and you'll develop your own skill and intuition. That's what makes a good trader: skill and intuition and attitude. Now back to why we use the number 1 and number 2 points to place our orders. Commodity prices tend to act like a ball bouncing between a floor and a ceiling. We call the ceiling resistance and we call the floor support. The principle tells us that if the ball, or the price of the commodity, breaks through a floor or ceiling, it has a tendency to keep going in that same direction. There's a number 1 bottom. It's the lowest price paid for corn in the last 12 months. We know that. So we see the ball bounce down to the price at the number 1 point. The number 1 point is evidence that the price is being supported from going lower. The ball bounces off the floor, heads upward, and hits a ceiling, the number 2 point. Prices resist going higher, bounce off the number 2 point, and again change direction. Will the number 1 floor hold, or will prices continue to drop? That's what the number 3 point is for. It tells us prices have reversed and hit a floor between the number 1 and number 2 points, giving some assurance that the number 1 floor is holding. When prices again change direction and head upward, the number 3 point is confirmed. Now the question is, will the resistance established by the number 2 point hold and send prices downward again? That's why we wait until prices break above the number 2 point to get filled on our order. Remember the principle. If prices break through a floor or ceiling, they will probably keep moving in the direction of the break. Counting on that, we've placed our order, and when prices break above the number 2 point, our order is filled and we're in the market. We place our stop below the floor that the number 1 bottom point established. If prices break below that, we want out of the market to prevent further loss until a new bottom is established. Remember, the key word in everything I'm teaching you is probably. The number 2 and 3 points increase the probability that these prices will continue to go up. Here's how our trade looks on a chart. All right, we've placed our order. Now we sit back and watch corn prices every day to see if they'll rise above the price of $2.32. For the sake of paper trading, we will assume when the price hits $2.32, our order is filled. When you place an order with real money, your broker will give you a call and let you know at what price your order was filled. Every day from then on, you can track the high, low, and close. Then the day comes when your price is hit and you're long 1 contract of March corn. Your account is settled at the end of each trading day. If you have any profits, you can call your broker for a check and it'll be in the mail to you the next morning. Imagine this. You're having one of those days. Your boss is irritable, or your customers, or your kids. Then thank goodness it's lunchtime. The markets have closed. You decide to give your broker a call. Congratulations, he says. You're up $1,800 in corn. You know what? It'll change your whole day. Probably the hardest part of commodities trading is knowing when to take profits, a problem I hope you will all be faced with. I'll give you a little hint that Ken gave me when I first started trading. You can never lose money taking a profit. And it doesn't matter if that profit is $100 or $200, or if you happen to be in a position where it's several $1,000s. Profit is profit. So keep that in mind, especially as you're starting out. Now we're in the market. We're interested in one thing, and that's where did the market close today? Or if it hit my stop, where was I stopped out? You can go through a lot of calculations to figure out point values, but we've made it easy for you. Every chart in your U.S. chart book comes with a legend, and that legend tells you the point value of each commodity. In fact, it tells you everything you need to know about the commodity. Then all you need to know is where you got in the market. which in this case is $2.32, and where the market closed that day. You will then take your entry price of $2.32, subtract the closing price, and multiply the difference times the point value. The point value in corn is figured in cents, where 1 cent equals $50. In other words, since one contract of corn is 5,000 bushels, if each bushel goes up 1 penny, that's 5,000 pennies, or $50. If the market goes from $2.32 to $2.42, the difference is 10 cents, times $50 for each cent. That equals $500. Drop all the decimal points except the one in the point value. Here's the formula.